Hello everyone, I'm Kunal Sodhani from Global Trading Center, Shinhan Bank, India, and we are here with another episode of Understanding Domestic and Global Factors, specifically in the volatile times, and having our views on several currency pairs. So first, talking about the flows, we have been seeing equity flows have been negative, and if we talk about the month of August, we have seen flows, negative flows to the tune of 4,500 crores. While on the debt front, there have been positive flows to the tune of 5,500 crores roughly. If we talk about EFX reserves, they're again at the all-time highs, but I think some kind of intervention might have been seen where rupee has been, depreciating, due to which I think the reserves data for the week ending this Friday may see some reserves being depleted. Overall, there are two important things first to talk about. One, obviously, the ongoing Middle East crisis, which definitely causes some risk on, risk off rally. So, in this scenario, it's obviously risk off. But most important is also trying to understand what's happening with the carry trade. That's the Japan carry trade or Japanese yen carry trade, as we say. So, ultimately, first, it's important that carry trade is nothing but obviously people usually used to borrow, or institutions usually used to borrow at negative or zero interest rates in Japan, and they used to invest that money into maybe US stocks or maybe longer high yielding bonds into several countries. Now, what used to happen because the borrowing cost was negligible, obviously there was no interest outlay to that much extent. But as and when Japanese yen also started appreciating basis on the interest rate hike which the Japan did, so the investors had hit from two sides. One, obviously, the borrowing cost going higher because interest rates have turned positive. So there will be an interest outlay which is higher, which the investor has to pay to the bank. And secondly, also because yen started appreciating from almost last week, it was 162 to almost 142 levels, or to be precise, 141.60. We have seen that lows. This appreciation of yen has also hit these investors from both interest rate side as well as on the currency side, due to which there were a lot of margin calls, and people had no choice, or investors had no choice but to sell off their shares in order to make good for the interest on the loan as well as on the M2M, which they were on the negative front. So that was a brief story, and that is how the unwinding started, due to which it has its own multiplier effect with several currencies, because ultimately money is moving out of US or countries like India or maybe other countries like China, due to which appreciation has been seen only in terms of the yen, but rest other countries have started depreciating, including INR. So that is one point. Secondly, obviously, Middle East crisis are still underway, and I don't think the markets have reacted that much even now, because ultimately it was the unwinding of the carry trade which has more impact at this point in time. Third important point is to talk about Fed, because the US data points were not in sync. If we talk about the employment data or the labor data, they were not in sync. So that is why the cut have been pricing in more aggressively in the market, where now the markets are pricing in September rate cut not by 25 basis point, but now by 50 basis point. Even the Fed speakers somewhere are split even now, where some are still being data dependent and some feel that there is a need for rate cuts to come soon because of some kind of technical recession hitting them. So there has been a split amongst them, but the markets are anticipating almost 100 to 125 basis point of rate cut for this year itself. While on the RBI front, we also have the RBI policy, where I personally don't foresee any kind of rate cut. It remains status quo, and probably monsoon will take its own play later on in the coming policies. Overall, if we talk about a dollar index, obviously after the Fed, rate cut being more aggressive, that is the talks, dollar index obviously cooled off towards the lower levels of 102.41 and then bouncing back near 103 levels. So technically 102.20 acts as an important support zone, while if we talk about the resistance level, 104.40 and 104.50 acts as a very important resistance. If we talk about Brent crude prices, still global demand concerns prevail, and irrespective of the geopolitical issues prevailing, still crude oil prices remain lower to the extent of $77 per barrel. But technically, if we see, these are decent levels to go long with a stop of $72 per barrel. Overall, if we talk about dollar rupee levels, we saw the last close, which is the all-time close, high close for dollar rupee pair at 84.85. But NDF levels have even traded to 84.14. Offshore intervention possibly have been seen, where again the rupee opening has been lower. But overall, for dollar rupee pair, we anticipate that 84.25 now acts as an important resistance, while any close below 83.6570 is required to bring any kind of consolidation. So the range has shifted now from 83.60 to 84.25. That's the broader range. So that's all from my side, friends. Thank you so much and have a wonderful trading and investing session ahead. Thank you.